here with Nik Dvornak, Portfolio Manager from Platinum Asset Management. Welcome, Nick.
Thank you, Mark. Good to see you again.
Likewise. We're talking about interest rates which are at historic lows, obviously. So are interest rates lower for longer, or how do you see global interest rates panning out from here?
Look, that's a great question, and it's quite a tricky one because you have two countervailing forces acting on it. So on the one hand, you have huge technological change. If you think about things like Google or developments like Airbnb and Priceline, these are companies that don't require a lot of capital, and of course interest rates are the price of capital. So the demand for capital is lower from the businesses that are driving economic growth today.
Yeah.
So that of course acts in one direction. It pushes interest rates lower. It also creates deflation. If you think about what happens to the cost of advertising, when Google came in, it pushed down the cost of advertising. It's reducing the cost of travel. Again, that pushes interest rates down. Against that, you have these large imbalances between consumption and savings. Countries like America, Australia, the UK, large consumers of capital. We consume other people's savings. Yeah. Countries like China, Korea, Germany, large providers of capital. What you're seeing now is Chinese consumers are beginning to consume more of their own incomes, which leaves less for them to export to us. That, of course, reduces the supply of capital. So on the one hand, you've got weaker demand, and I think we've seen that playing out, but what you're seeing increasingly is also weaker supply of capital. And I think that's probably going to be the dominating force, suggesting interest rates do tend to creep higher from here, in my opinion.
Yeah. So to quantify, looking at, say, the 10-year rate in America, which, in my opinion, the most important rate in the world is the long-term rate, 10-year rate. 10-year rate in America is, what, tad under 2.5 at the moment. Where do you see that going on a 3 or 5 year view?
So the first point to make is that's already increased quite a bit in the last couple of months. Look, I mean, I think I'd be quite prepared to suggest it should be over 3%. Yeah. Whether it gets back to the kind of 6% level that we were used to before the global financial crisis, though, is a different question. I think it's going to struggle to get back there. But certainly it should be well above 3% in the next year or two.
And the significance of that, obviously, is everything's priced against that. So theoretically, the higher the price of government bonds or the risk-free rate, the lower the price of property or other assets. So in terms of that rate, what rate are you using in 10-year bonds to do your valuations on property or the share market? Where are you doing that at the moment?
That's a good question. Look, we don't explicitly look at the interest rate to guide the valuation of these businesses. I think the much greater uncertainty is the future cash flows they generate, and we try and concentrate on getting that right. Yeah. Yeah. We typically buy businesses that are misunderstood, and so we try and use our understanding of how that business will progress to inform our judgment on what we think the cash flows they will generate, what cash flows they can generate. Typically, the companies we buy are cheaper than peers for whatever reason, because we do look for businesses that are unloved or underappreciated, and so we think they will be much less affected by a change in interest rates.
Okay, so bottom line, rates are likely to rise on a supply and demand, which makes a lot of sense to us, and certainly if you're a heavy mortgage owner in Australia, you should be banking on that.
Yes.
Thanks for your time, Nick.
That's about right. Yes.
Thanks for your comments.
Thank you, Mark.